All right, what a way to finish off this week. So we finished finished the week with a nice strong rally today. So we're going to talk about this rally in context of the weakness that we experienced earlier, and whether or not this turns things around. Where there might be some resistance, what should we expect next week? From a seasonality perspective, from the technicals that we're currently seeing this particular year, this particular October. So we're going to break down expectations based off what these technicals are telling us, and then put that into the context of our expectations for the broader quarter and this intermediate run that appears maybe that already has ended on the Russell, that may be really close to ending on the S&P 500, at least temporarily. So we're going to break down the technicals. We're going to look at a stock for our trade idea today that's really kind of pulled back. It's had a great run. It pulled back towards support. And we're going to talk about how we can take advantage of a speculative directional opportunity with earnings coming up. So let's go ahead and get started. Today is Friday, October the 4th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 and take a look at what's going on here today with the market forecast indicator. So nice continued rally in back up towards that support that we had broken down below here earlier this week. Closing still inside. See this little Fibonacci retracement zone, the larger one of this intermediate rally. We had broken down into it. We got above it on that breakout on September the 5th. On that gap, we came back down, and now we filled in this gap from earlier this week, and you can see we're kind of back up to that area again. Again, there's some resistance in this area, as you'll see here in a second. So I think we'll still have some weakness early this next week. That's a good end of the week close here. You consider that we opened the week here at 29.6707, and we close at 29.50. That's a pretty small body. In fact, if you look at the weekly chart here, you can see how small that body is. And again, long lower shadows tend to be pretty bullish. Now, it doesn't mean you can't fill in the range like you saw here. You can fill in the range of long lower shadows, but they tend to be pretty bullish, at least in the short term. So that's a good sign. Just watch out for next week, at least early in the week. Next week seasonally is a bearish time for the markets. When you look at the seasonality chart here, if I go back all 20 years and then switch to a prices percentage here, if I zoom in, you can see this week right here. Here's where we're at 10.4. You can see over the last 20 years on average, we fall. This week over to 10.11. That's next Friday. So, there's a good possibility. Now, granted, this week has been a bullish week, and we weren't necessarily bullish. We didn't finish higher. We also didn't finish that much down either. We had a pretty decent last couple of days. But heading into earnings season, next week still isn't quite the big earnings season yet. But then you can see from that point forward, we get pretty bullish by the end of pretty much by the beginning of November. A little bit of weakness heading into Thanksgiving, and then coming out of Thanksgiving, the bullishness into the end of the year. So we're heading into a decent time of year from next Friday going forward into the end of the year from a seasonality standpoint. We've been pretty unseasonally. We've been pretty flat. I mean, this is a relative flat time of year from the peak. We usually peak in July anyway, at July expiration. We peaked a little bit afterwards, a little before and a little after that. And then it's been choppy ever since then, some ups and downs. We were so bullish for the year, way more bullish than we typically are on average over those years. So keep that in mind. And we had some choppiness during this choppy period too, some ups and downs before peaking up there. So, there's been some moves here that have been relatively unseasonal, but we are setting up, again, for a good end of the year, fourth quarter run. Here, let's get back to SBX here for a good end of quarter run, and this was a good way to finish what was for a little bit of time a pretty bearish week. So positive, we're not back up above. So again, that's why I say that Fibonacci area here, we kind of have to get back above that I think we'll hit our head down a little bit and maybe come down, maybe even fill in this gap on Monday and Tuesday before bouncing off of this area and rolling to the upside. In fact, if you take a look at the Bollinger Bands for the stock here, well, let's look at the 4-week range here really quickly. You can kind of see where, now let me activate these Fibonacci lines. So you can see as if we come down to the 60% and to the 50% area where yesterday's high point was, that would fill in the gap, maybe down to 290, maybe a little bit below 290 to get to that little area, 50% retracement. Then we'll bounce back up. We might move up a little bit more Monday, maybe even start up higher. You know, taking advantage of, that's a good bullish move, 10 points over a couple of days, almost erasing most of that decline, almost, not quite. And so, you know, again, early weakness, but then I expect, you know, because there's not very much volume below us now. See, all this little bit of volume was above us. Now all that little bit of volume, because we moved up so fast, is below us, which makes it easy to come down. But this is a big chunk of volume up above us that's going to be weighing down on us anyway. So we'll probably come down, fill in that gap, path of least resistance, and then we'll move back up to the upside. And so from a market forecast standpoint, you know, where we're just barely coming out of the lower reversals on the short-term sentiment, I don't necessarily think that we're starting a 7 to 12 day near-term rally. We still have a weak bullish posture. I think we'll maybe come up to 80 because of the strength of these 2 days, but we'll probably do something like this again and then come down and form another bullish near-term low on the pullback sometime next week. Then bounce off of that. We have to clear this area here, 2998, 2988, 2990. We really have to clear above these highs. You'll see that here in a second. There's another resistance level in there anyway. Once we get above those highs, then we'll feel better about, okay, we're taking off now and we're starting to move back in the positive direction. From a Russell 2000 standpoint, not quite as bullish. We have been more bearish, right? We had the dark pink shading and the red line, so we were more bearish to begin with. So again, same thing. We're not out of the woods. This simply was just an oversold technical bounce, and that's it. This is not a, oh wait, we were bearish and we were wrong, we should be really bullish. Hardly the case. There's no catalyst that will just shoot up here. More likely, of course, anything can happen. This is just that we were really oversold, too oversold, and buyers came in because there's a lot of good value. They'll stop coming in when there's not as much good value anymore. All right, before we look at some other charts, I do invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also a red subscribe button down below the video if you're watching this on YouTube. On our YouTube watch page. Hit the thumbs up icon that's down there too. That lets us know, number one, you liked our video today. Pretty straightforward. And number two, you want us to do the video again tomorrow. It's a quick way to give us feedback. It's our only feedback that we get. We check that every video. So let us know if you like us to keep doing these videos. Hit that thumbs up. If that's not the case, then don't. One click. You can do that right now while you're watching. Also, while you're down there, comment. What stood out to you from today's video? Let us know down in the comment section. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. You can click that link and join our site for free and join our Market Scholars community. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook community that we've created, our Market Outlook Facebook group that we created. All right, if you're watching this on our blog page too, I want to note out that we do all the Market Outlook trades that we do from day to day. We also manage those trades all the way to close in our Market Outlook live videos. We do these every day. I do the Market Outlooks at 3:30 Eastern time. They are live. This is the link to get to that video, and again, this is available for all of our monthly subscribers as well as our premium subscribers. If you scroll down below the video, we invite you to engage with us on social media. Hit this heart. That will open up this new window. Click on that like button for those that have Twitter accounts. For those with Facebook accounts, click this image. That opens up today's Market Outlook Facebook post. You can like and share that there. Again, the more you just simply like those, the more Twitter and Facebook will always push our content to the top of your timeline whenever you open up your app, so that you always see what we put out there. So it's the algorithms that they have. They don't show you everybody that you follow, all their content. So to make sure you see ours, you have to engage with us. And we try to make it really easy for you. All right, now let's take a look at our at the long-term chart here for the S&P, and you can see that big Hakinyashi candle, big long lower shadow. Now a lot of times we can still fill in the range of these long lower shadows, so kind of keep that in mind, that we can still be bearish to next week before turning things around. And when you get the longer bodies, they tend to set the lows on these, especially on the daily chart when you look at them on a daily chart. So we got a big body here a couple days ago. We had bounced back up, and now we actually have a bullish candle on the daily chart. But we can still have a week or two of bearishness to get a bullish candle. That the next week's Hakinyashi open on SPX is going to be right around let's see here, the open and the close 29.75.80, and the close 29.41.89. So the midpoint of today's body, this week's body, excuse me, is at 29.58. We're at 29.52, so we're that close to having a lower and an upper shadow next week on the Hakinyashi. Of course, we would start, barring a gap on Monday morning, we would start out with the lower shadow, and moving up through 29.58, you would get an upper shadow at the very least. So it kind of gives you an idea of just how bullish this little rally was here at the end of the week. And again, just on a regular candlestick standpoint, that's a very good sign. But it doesn't mean that we can't fill that in a little bit, at least, like I said, early in the week, get another little lower shadow similar to here before we continue higher. In fact, that week we finally had closed there before we moved higher, and it took a couple of weeks for that to happen. Let's take a look at the 3 green arrow chart, and you can see we don't quite have 3 green arrows. The MACD histogram has turned back up again. It's a positive element. The stochastic's got a green arrow, but still very weak, similar to a weak intermediate posture on the market forecast. And we are still kind of right at the moving average. We're not above. We're not above or below. It's a light pink shading here because we do have the three red arrows, but now we don't. And if you take a look at the 2-line versions of this chart, you can see the MACD is trying to turn back up again. You see the histogram turning up, as we saw earlier. You see the stochastics crossing up above not only that 25 level and getting us that green arrow, but also crossing above its moving average. So positive development. You can see the 8-day is we're back above the 8-day moving average with today's close. So we might pull back down below it, like I said, maybe Monday or Tuesday to fill in that gap. Then again, it's crossing back up above the 17 and getting this orange line, which is a smidgen below, to get that to turn back up. That's when you'd feel a lot more confident about being bullish there. If you look at the intraday charts, again, as I mentioned, there's a big block of volume sitting right above us. So it's gonna be hard to keep going. We've made a nice move because there's so little volume. Now the so little volume is below us. So keep that in mind. If we pull back on Monday, there's going to be a lot of chatter about how that was just a nothing move, and that's not the case. There's resistance above. There's very little volume support below. We're going to most likely going to fill in that gap right there. That's not any kind of breakaway gap. So look for that to happen Monday, if not Tuesday. But also look for some support in this area, like as I mentioned before, and before we turn back up to the upside. Of course, as I mentioned before, on the 2-line versions, on the daily chart, you see how there's also this resistance of the value area there, and you see the tops of these candles, as I mentioned before, that's where this last volume node is. So as I mentioned, if we get through those tops of those candles, that would mean that we're getting through that volume node, and that would be our last resistance that we have left to really take off to the upside. So that being the case, that's kind of what we're watching. So again, you pull back down to 290, there's a lot of volume. That's where it picks up this volume here. It's not, you've got some big volume support below us. So don't get worked up if we pull back. Just anything that you like that you didn't feel like chasing the last couple of days, watch for some opportunities in those areas the next couple of days, and you might get your chance that you might have missed out on here before they turn back up and head higher again. Again, if we break through, that's a moot point if we break through these highs and, like I said, break up through 280, 298, and we're really off to we're now on that Q4 rally to the end of the year that a lot of people are expecting for a lot of seasonality type factors and other reasons as well, considering how bullish we were at the start of the year and a lot of different reasons to be bullish into the end of the year. Let's take a look at the daily volume and the range. You can see, again, you have to keep in mind the gap that we had this morning. So 29.10. Here, let's actually go to SPY so we can get the volume. You can see the volume was less than what we saw yesterday. So we're already back down to 66 million shares. And then we closed at 290.42. Low was 290.82, so 40 cents. So about 420. So we're a little bit above average on the ATR. Right here, a little bit above average on the ATR, 4.2 points, a little bit below average on the volume. So not too far up above to where we'd be like, oh, that's too much of an upward day. You can see, that was like one of our first, right here. That was our first 1% move that we've had in a while, right? We haven't had a 1% move since that gap, since the September 5th gap where we broke through with that volume that broke through these highs. So that's the last time we've had one, and we're coming off a couple of 1% moves to the downside. In fact, the first ever 1% moves to the downside that we've ever had going into the fourth quarter. It's just the fourth quarter, right? We've had plenty of other quarters start off with 2 consecutive 1% moves. This is the first time the fourth quarter has started off the quarter with those moves. So this, again, simply just a 1% move to the upside. If we continue to have that kind of volatility, 1% up, 1% down, that's bearish. We don't want that. So, you'll expect that we'll get inside of this 1% band, kind of more into that 0.5% level, which you can kind of see here. If I zoomed in a little bit, you can see, for the most part, we were within the 0.5% level with a few outliers here for a long time for most of that sideways action that we had. Now let's take a quick glance at the volatility index, and you can see, again, this little rally that we had, that jump in volume, we really took advantage of that in our options inventory class. We put on a lot of inventory expecting that volatility would drop, and lo and behold, it did ever drop. So it's been a really, really good thing for our inventory that we've done. That was the expectation. It's continued down. Again, there will be some support here. Now that we've broken through, there will be some support. Breaking back down below 90%, again, that means that we're back. We're back to the bullish trend that we're going. So this little bump in volatility was a lot to do, much to do about nothing, essentially, at least from a volatility standpoint. Had we gotten above 105%, that's a little different story. Had we gotten above 115%, now we're talking like, we're going to be bearish for a while. We're getting a market sentiment pullback, so sell the rallies. This is not a sell the rally type move. A little weakness maybe, but not a sell the rally. We do expect that you'll break through that 90% here sooner rather than later. All right, before we get going and take a look at what's driving the price action today, and from a fundamental and a market standpoint, as well as our trade idea for today, which we already put on in our live market outlook video, but we'll talk about what that trade idea was here at the end of today's video. Summarizing our technical outlook, we've had a little bit more of a pullback than maybe we expected here this week, and today and yesterday's rally was simply just an oversold technical bounce. That doesn't mean that we're right back on that bullish gravy train again. There's still some things that need to be worked out according to some of these technical indicators. From a seasonality standpoint, too, thrown in there. There could very well be some weakness, barring any news coming out of the trade talks that are scheduled for next week. So barring any news from there, from a technical perspective, still some things to work out in the short term before the bullish trend continues, the expected bullish trend continues going on through the next earnings season into the end of the year. So what do you think? Do you agree with that assessment? Do you disagree? Vote by clicking up there at the top right corner of your screen. Hit that link. Opens up your poll. Vote either agree or disagree. If you click disagree, comment down below on what you're seeing that's different. Then that gives you a different posture from what we just came up with here. All right, now let's talk about what's driving this action. Let's bring up the asset class. You can see the S&P 500 was the biggest winner today. The value, these value stocks was the next in line. I do want to bring up here, let's bring up the asset class comparison first on the one grid. And then let's just take a look at just this week and how this week ended up turning out. So we'll go to October or September the 30th there till today, and we'll go to like a 10-minute chart. So at the lowest point of the lows, crude oil was down 8%. I mean, that's a big move to the downside and doesn't get talked about very much. That's a big reason why there's a drop in risk appetite. By the end of the week, it's only down 5%. So it's a 3% plus move off those lows, and that brought a lot of these areas up. Again, that was off of, pretty much the 10.3. If I were to come here and do 10.3, you can see what that looks like here. So started off positive. We came down. You can see gold and bonds started off today really strong. This is coming off that ISM number. They started off really strong there, but then you can see crude oil rallied off of those lows. It rallied significantly. The S&P 500 was the second worst performer coming off of that release. It rallied heading into, up 2% essentially off that lows. Emerging markets rallied. Long-term treasuries, interestingly enough, rallied. So yields continue to fall, which even with this move today, yields continue to fall. That's setting up the odds for the Fed still to cut interest rates at one more time. You can see the dollar stayed down, and that lifted gold prices up a little bit, but not from a risk appetite standpoint. The only thing that's really not participating, you see REITs up there, are small cap stocks. There you can see the small cap stocks really lagging behind. So again, if we're gonna be bullish, small caps have to take some leadership here. Unless the dollar really remains strong. In fact, if you take a look at the dollar's move here this week, we had a strong start to the week. Then the rest of the week it just came down. Now it's in the midst of a little bit of a pullback here. You can see the candles are getting smaller. We had a bullish move. We're getting a little bit of a smaller move. So it's not surprising that there's a little bit of a consolidation back to the moving average. So it hasn't changed its trend, but a little weakness in crude oil. Now you notice so the dollar's been strong, but look at that move in crude. Crude is really weak. In fact, if I were to zoom out a little bit, it's pretty much down to some support in this area, right down to the 62% Fibonacci retracement. So breaking that support will not be a good thing for crude oil. Now, I don't think that will happen because, again, inflation expectation. One of the reasons why is inflation expectations have gone down so much, and that's why the yields are down to those lows that we were at before. If I were to throw this on the linear regression and put the TNX back on there, let's go back 5 years actually. There's your 5-year linear regression. So there's not a lot of room to the downside here for yields, but you can kind of see what the market's trying to tell the Fed is that with the idea that the Fed funds rate is still the 10-year note is still below the Fed funds rate here. In fact, let's just go to 1 year. There we are. That's not today. It's still yesterday's value. But we're still, more than 25 basis points. And that's not, this is an environment that's conducive to rate cuts. So not surprising that we still got some odds, even though they're lower now than they were. They got up to about the 90%, but still by the end of the year, whether it's October or December, there's still a 90% chance we're getting a rate cut by the end of the year. The question again now becomes whether or not it's the only rate cut we have left. And you can see there's about an 80% chance that we'll get another rate cut into the next year. Now, keep in mind, into the end of last year, we had the odds of at least two rate hikes in 2019 going into December of last year. So, that we get a rate cut and things can definitely change. But as of right now, there's an 80% chance that we'll get at least one rate cut here at the beginning. And remember, the mid-cycle adjustment is to have 3, not necessarily an indefinite amount. So we'll see what happens if and when. And really what we need to have happen is that to stop. And once those rate cut odds start to go away, then you'll see the 10-year notes rally. And there's a good chance. As weak as the indicators were, we still have a really positive number, more positive than we've been all year long on the Citigroup Economic Surprise Index, and more positive for most of the second half of 2018. Even with this pullback, and you can see the G10 pulling back just a little smidgen below, down to what would be this first hash mark. The chart's not updating for some odd reason, but down to that first hash mark is where it's pulled back down to. So a little bit of a pullback, but still a lot better values we've seen in these indicators than a long time. Next week's calendar, you can see that we do have consumer sentiment, inflation coming out, PPI on Tuesday, CPI on Thursday. Jerome Powell is speaking this week. You can see multiple speeches here. You can see there's Neil Kashkari speaks a couple of times. Mr. Rosengren is one of the people who didn't want this cut that we had last time. So we have a few, and the FOMC minutes for that matter. And again, we had 3 people, one that wanted 2 rate cuts or 50 basis points, and 2 that didn't want a rate cut at all. So it's going to be interesting to see the FOMC minutes and how that leads us into at least this month's meeting at the end of the month. Take a look at next week's earnings calendar. You can see Monday we don't have anything. Tuesday, we do have Domino's as a main name, and Levi Strauss, which is one of the IPOs this year. That's actually that stock. If you take a look at, there's been so much news about some of these other IPOs. This came out in March, and it's not doing. From 24.50 down to 16 before this last little move to the upside over the last so many weeks is what the daily chart looks like. So it's not like Levi's been doing really good either. Just hasn't had the publicity as some of these others. But that's out on Tuesday. You can see, here on Wednesday, no significant earnings releases. On Thursday, we have Delta Airlines, and then on Friday, we have Citigroup and Fastenal. So now we start picking up, right? And then the week after that, things really start getting hot and heavy. There's Monday next week. There's Tuesday, JP Morgan, J&J, Wells Fargo, United Health, IBM, Netflix, Goldman Sachs, Morgan Stanley, BlackRock, all these really, really big names here, Progressive Interactive Brokers, United Airlines, lots of big names coming up. So next Tuesday we really start off, and there's Abbott Laboratories, U.S. Bank Corp, lots of banks, CSX, Kinder Morgan, Crown Castle. You can recognize a lot of these names. So next week, as we said before, it's seasonally a bearish week. But the week after that is when, from the market standpoint, we tend to be bullish as all these earnings releases start coming out. From a foreign market standpoint, you can see some dark green shading in here, and both of them have green lines. So Japan's really bouncing back up nicely. South Korea is bouncing back up nicely. So those are your most bullish charts that we have right now. China is the only light green shading that we have. And then you have some light pink. United States, of course, we don't have the intermediate line falling below 50. India either. You got some yellow lines on there. There's some bullish patterns. Same thing with Italy, Canada, and Brazil, like light pink, yellow lines. Brazil actually has the green line. We're jumping back up above that. And then, of course, the worst right now is Europe, Germany, UK, France. They're really struggling. They're dark pink shadings are below their moving averages. They bounced. They didn't bounce nearly as much. And Russia also didn't bounce nearly as much. So you can kind of see where the weakness is in globally. It's in that developed space that's not in Asia. The Asian space is looking really well. And then you can see some of these others that are kind of in between, in the middle. All right, if I take a look at the sector rotation, the last 3 months, you still have a lot of strength here in these safe haven areas. This is not a bearish pattern, right? A bearish pattern is when they're down on the bottom. That's when you expect to see bearishness going forward. This is a reflection of volatility that they're doing so well and the broader market hasn't. You can see cyclical dollar sensitive areas like materials and energy down, healthcare, financials, industrials. They had bounced up so nicely. They pulled back again, so they're still weak. If you look at just today, financials did really well. Consumer stocks, staples, technology, healthcare, all kind of up there. On the other end of the spectrum, real estate lagging, materials and energy lagging, dollar sensitive areas, discretionary lagging. If I take a look at just this week, so let's customize this and go down to October. We'll go to the 30th there. And just look at how this week has performed. Again, it's all about, everything pulled back. And that's a really good sign, actually, when correlations get higher as everything moves together. And then you shift to just these last 2 days coming off these lows. You can see, look at technology, communication services, discretionary lagging a little bit. You like to see that up there. Healthcare bouncing back up, financials moving higher, staples up there, and then your real estate and utilities all down there too. Still all moving up too. And again, as correlations get stronger, that usually leads to a good bullish move in the market. They usually get stronger during periods of volatility, and then they get weaker as we move higher. So the fact that they are stronger leads us, it sets up an environment for a potential bullish end of the year coming out of this type of move. Let's take a look at the 12 grid for this chart, and you can see what our best performers are still our safe haven areas. They got the dark green shading, they got the green lines, right on the moving average. So those are still our best performers. Kind of in the middle, you got some light green shading and yellow lines, red line on healthcare, but communication services, their intermediate lines are rising. On the flip side, you have financials, which is trying to figure things out and get going again to the upside. Then you got all of these, this weak performers, real estate included in there now. Now, real estate at least has a red line. Industrials has at least a yellow line. Industrials and materials, you can see energy's struggling, discretionary struggling. So that kind of needs to take hold and join technology as a top performer. If we're going to be bullish, you can see it's lagging. I mean, all three of these kind of lagging to different degrees, except the other two lagging to different degrees. They need to kind of join up with technology and start to outperform here. All right, now let's take a look at our trade idea of the day. And the stock I wanted to take a look at that's had a really struggle here after a strong move earlier in the year is Starbucks. You can see it still has a 1-year return of 55% despite the pullback over the last 3 months. And after this kind of post-earnings really kind of blow-off top move that produced this overbought cluster towards the end of an intermediate rally, at least along this kind of intermediate rally that we've had for a while. You can see this week a couple of clusters showing up here this week, a couple in a row. This is what it looks like on the 5-year chart. The short-term sentiment really getting to extreme and starting to pop up here with a long lower shadow. You also see I've also got the 62% Fibonacci retracement drawn in here. So it's dropping down into right at that level right there, where there's some sideways action. That's the 62. That's the bottom of the Fibonacci retracement zone of that intermediate rally. If you look at it as well on the Bollinger Band standpoint, there's also a volume node. It's not the biggest, but there's a volume node in that area too. That happens to be right at the bottom of that Fibonacci retracement zone. So multiple layers of support, and you can see from a linear regression standpoint, really extreme move to the downside on the 1-year chart. Obviously on the long-term chart, not necessarily the case. That's how bullish this move was. But on the 1-year chart, we're oversold in the short term. We have an opportunity to make a run, especially if the market makes a run, opportunity to make a run into here, especially in earnings coming up to the upside. So the idea being, then we say, okay, well, let's go to the risk profile, and you see we already have another trade in this, an iron condor trade in class. But you can see, we can say, okay, what if we were to sell the 92.5 and buy the 90 call option? This is what it looks like. So here, let's hide the positions that we have and just look at our simulated trade. It's up a little bit in price, so it's already up a little since we got into it. But the risk ends up being about, what is it? Here, let's get back to just a one contract. $66 for a potential reward of $184. And again, 3-to-1 reward to risk ratio, the worst case scenario, but the idea being that we don't take full maximum losses on these. We can cut that loss in half at about $30, and now you have about a 6-to-1 reward to risk ratio. That's a pretty decent reward. You can see between now and November expiration, we can move up to 94 according to current volatility levels. You can see on the Bollinger Band chart, you can see that visually here. Here, go back to Starbucks here. There's the 1 standard deviation by November expiration. So it doesn't have to clear that big volume node. It just has to kind of get above that one, this high point. We'll see if that ends up happening. If you look at the MACD histogram, we've had a pretty decent move to the downside there, and we kind of diverged with this extra move. And now the idea is that you would target the top end. That gets us up to about 92.5, if not through that, which would get us our reward for that little bit of risk on that trade. All right, well, that wraps us up for today. As always, thank you very, very much for watching our video today. Remember, you've heard from me now. I want to hear from you. Use that link right there. It takes you to our Market Outlook forums on marketscholars.com. You have to be a free subscriber, at least a free subscriber, to participate there. But open up any new threads. And with any questions or comments you have about anything we discussed in the video today or anything we didn't discuss that pertains to this topic, love to keep this conversation going over the weekend and into next week. As always, subscribe to our YouTube channel, hit that thumbs up icon down below the video, and comment. Follow me on Twitter for more content in between from video to video, and join our Facebook group that we created on for our Market Outlook Market Outlook group that we've created on Facebook. As always, thank you very much for coming on. Have a great rest of your weekend, everybody, and we'll see you all next time.